What is the discounted future cash flows method of valuing a business? Well, in summary, this is simply taking the free cash flow of the company and dividing it by a discount rate. Now, this is very similar to earnings capitalization, except that you are looking forward and taking the free cash flow that you expect every year in future years and adding them together to come back to a present value. So instead of dividing just by discount rate, you're dividing by 1 plus the discount rate to bring back present value in a given year, and then each year's present value, you simply add them up over time. So how does this work? Well, first you need to come up with what is the free cash flow of the company, which is just the company's incoming cash flow minus operating expenses, any taxes you have to pay, any changes there in working capital and capital expenditures. Now, when you're looking forward, this is very difficult, so you have to look backwards to determine what you expect these figures to be over time. So you make projections, and then you determine the discount rate, which is basically the cost of capital for the company. Now, there are more complicated methods of coming up with the discount rate. So discount rate is generally something like the cost of capital for a given period of time that is a combination of debt and equity. Now, if you do this for a larger, mature company, then you're going to take into consideration the capital structure of the company, because part of the financing that they have is in debt, and part of it is in equity investment. So you would have to figure out what the rate of return on that equity investment is and the rate of return on that debt investment is. Generally, for a startup venture, you don't need to do that. You would look to the market to see what similar cost of capital or similar rates of return expected by investors, venture capital firms that are putting money in this type of venture. So it all starts with whatever the risk-free rate is, and then you add whatever you believe the risk premium to be, which is the industry premium plus any size premiums or market premiums out there to come up with a discount rate. But in a mature company, you'd go through the capital asset pricing model and look at the company beta and add that together with any company-specific risk to define what is the discount rate for the equity portion, and then whatever the debt that the company has, what is the market rate for debt in that debt class, and then you'd combine those together based upon their weighted average to get a discount rate. But regardless, you're using a discount rate to bring the future cash flows back every year. So say my cash flow were $100 each year going forward. So I would say $100 divided by 1 plus whatever my discount rate is. Say it's 10%. So 1 plus 0.10, so 1.1, right? That first year's discount is the free cash flow, $100 divided by 1.1. Now the second year, you would expect that discount rate to happen over 2 years, so it needs to be discounted twice. So in the denominator, you'd have the free cash flow of $100, and in the second, the numerator, the denominator in the second year, you would have 1.1 raised to the 2, so 1.1 times 1.1. Whatever that comes out to be is the denominator, and you divide that into free cash flow for the second year. And you would continue this for every year out that you project. Now, after a certain amount of time, 20 to 25 years, the value goes down to nearly nothing. What is the present value of the company based upon those multiple future cash flows going out? So that's how the discounted cash flow method works. It's a pretty simple concept in that you're taking future free cash flows, dividing it by the expected rate of return of investors who are putting in that kind of money, and then for each future cash flow that you're projecting and discounting, you add them all up, and that's the present value of your firm. So the discount of future cash flows method of valuation.